Welcome to the daily update, where I'll go over the action in the market for Wednesday, November 27th, and we'll see how things look for Friday, November 29th. The market will be closed Thursday for Thanksgiving. I'm recording this before Thanksgiving, so right off the bat, I just want to wish everybody a very happy and safe Thanksgiving. I'm very grateful for the people that watch these videos and try to get some value out of what I'm trying to do here. And so I'm very grateful for that and thank you. Some of you will probably be watching this video after Thanksgiving. I hope you have a good Thanksgiving weekend. You're probably watching this on Black Friday. So try to stay safe out there as you bargain hunt for some really good deals. Okay, before I get into the video, there's a thing called the SPX Investing Program. It's still free through the remainder of 2024. And I'm really going to be rolling out courses and a lot of additional things at the beginning of 2025. But if you want to go check it out right now, you're free to do that. There's a link that'll take you to the website or to a video that talks about the program. If you have any questions, you can email me. If you are a member right now, you're watching this either before or on Thanksgiving. If you're not a member, then you're probably watching this at the end of Black Friday. That's one of the benefits is right after I put out the videos, which they're designed to be watched before the market opens or at least before the close, because everything that I do with these strategies that I implement focuses on the close. So if you can watch that video before the close, that's more advantageous. Where if you're not a member, you get access to the video right after the close. And also the daily video, that's the real foundation of the analysis and commentary that I do. Over the weekend, I prepare a number of weekly videos, but they're all meant to tie into the daily video. Okay, let's go back and talk about what happened. We did have a lower open, and prices ended up falling below the daily pivot at 6,013. We also fell below 6,000 there at S1. Then we did find support and we were able to rebound and close slightly below S1. So we were down 0.38% on below average volume. This is pre-holiday volume, not really a surprise there. We're going to have an abbreviated session on Friday. A lot of people are already off doing their Thanksgiving plans, and so to see a slow day on Friday will not be really that surprising. And both Tuesday and Wednesday of this week were also below average. Not a real surprise there. We are still positive in the short, intermediate, and long term. There are some things that we're concerned about, some potential areas of weakness that we want to keep an eye on that could have impact on the S&P itself. And we did get the core PCE. I'll be going through that in just a moment as far as inflation is concerned. Interest rates actually came down a little bit. And because of the holiday weekend, because of all the transitioning that is taking place politically, because of what's going on between Russia, Ukraine, and Iran and Israel, even though there's a ceasefire, that could, of course, that just means stop fighting. It doesn't mean the end of the war, but that could resume at any time and ultimately have some impact on the stock market. And then all the cabinet positions that seem to be creating all kinds of pop news that were as those things are becoming a little bit closer to actually happening. Okay, so mega caps and growth did underperform. They did not have a good follow through day on Wednesday, where they did have a pretty good day on Tuesday, and the broad market outperformed. It's kind of a reverse of what we saw on Tuesday, where the mega caps and growth did well on Tuesday and the broader market was more weaker. Well, in Wednesday's session, the broad market was stronger, where the mega caps and growth actually underperformed there. We do have a non-confirmed Hindenburg omen, and I'll show you the chart here near the end of the video. Our list in the short term for either showing positive momentum or that we're getting extreme is pretty short right now. We have the Williams percent R and the stochastics. And then in the intermediate term, the Sean trend meter. Now, this could also suggest good, strong intermediate term momentum. And then really no changes to the scenario. The thing that's kind of spooking the markets a little bit are these stronger than expected economic reports, which are creating doubts that the Fed will be able to cut rates or continue to cut rates. The dollar was down and interest rates were down. We closed at 4.24% with the 10-year yield where we had been at 4.3%. And we're back to being uninverted with the 10 to the 2 year after it spent one day being inverted again. And we're still inverted with the 10 to the 3 month yield curve. We didn't change as far as sentiment. We were at 64 after Tuesday. We're also at 64 after Wednesday. And we're still not trending. With the down day, the ADX was not able to cross above the moving average. It's getting close, both in the short and intermediate term. And I'll show you those charts. I kept a bias at mixed because we ended up having a down day for the S&P, but it held up fairly well, and the broader market held up fairly well. So that's why I have mixed here. We're still positive when we look at the last 2, 3, 4, 5 days taken together. So I have a whole list of economic reports. I won't have charts for all of these, but a lot of them I will because Wednesday was the big economic report day. We had the weekly MBA mortgage applications index. It came in up 6.3%. Last week it was up 1.7%. Personal income up 0.6%, much higher than the 0.3% they had expected, which is what we saw last time. Personal spending also up more than expected, at up 0.4%. They expected it to be up 2%, but down from the 0.6% in the last report. PCE prices up 0.2% as expected and what we saw last time. This is the inflation component, the core, which was up 0.3%, which is what they expected and also the same as what we saw last time. We're still seeing a lot of companies, they're not willing to let people go, but people that do lose their jobs are tending to stay unemployed longer. Where the weekly claims came in at 213,000, they expected 217,000 and down from the 215,000 we saw last week. And this is the number that keeps going up. The continuing claims, 1.907 million, where last week it was at 1.898 million. And I have charts to show you of this. Durable goods came in up 0.2% less than the 0.4% they had expected, where last time it was down 0.4%. When you take out transportation, up less than expected. It was up 0.1%. They expected it to be up 0.3%. Last time it was up 0.4%. And I don't have charts for this. The advanced international trade in goods, minus 99.1, which is basically a higher number, less negative than the 108.7 billion we saw last time. Retail inventories up 0.1%. Last time they were up 0.6%. Wholesale inventories up 0.2%. Last time they were down 0.2%. And we got the second estimate for GDP at 2.8%, which is what was expected and what we saw last time. So no surprise there. But with the deflator, it actually came in a little hotter than the 1.8% we saw last time. This time it came in at 1.9%, and it was at 1.8 last time. The Chicago PMI came in at 40.2. That's below 50, so it's showing contraction. They expected it to come in at 45. Last time it was at 41.6. And pending home sales up 2%. They expected them to be down 1.5%. Last time they were up 7.5%. Whew, lots of things here. So here are some charts. The weekly chart that we look at for mortgage applications are going up. Just seems to be a little bit more favorable right now. Durable goods on a year-over-year basis are above zero and going up here. Non-defense capital goods orders also going up above zero. Month over month with durable goods, where we had seen declines over the previous months, now we're seeing them turn slightly positive. And real GDP with the deflator, GDP is the blue line here, which is actually declining a little bit on a quarter over quarter basis. And we're also flattening out to slightly declining with the deflator. Personal consumption year over year, people are eating and drinking more here. And then a little bit of a less reading when we look at the net exports here. This is always a negative number, but it's a little less negative. Real GDP year over year is coming down, but still positive. That's the takeaway from this right now, is we have positive GDP. If we have negative GDP, that means we are in a recession. And then the Chicago PMI is declining, so showing a contraction in that particular area. And then month over month, the pending home sales up, but less than what we saw last time. Year over year, we are seeing an increase. Personal income and spending, where we have the spending going up a little bit with the blue line, also going back up a little bit with the income on a year over year basis. And the core inflation. This is the one the market pays attention to. It is starting to turn back up on a year over year basis. And this is what the Fed really likes to look at as far as their inflation gauge. This going up may cause a little bit of a concern. Personal spending month over month was positive, but down from the previous reading. Here are the weekly jobless claims, where we see this really falling down, and the 4 week moving average is also declining. But when we look at the continuing claims, we're continuing to go up, and the 4 week moving average is also going up. So we look at all this together, where we have the unemployment rate, the most recent one at 4.1%. And then the blue line are the continuing claims, which are going up, where the initial claims, the red line, are going down. All right, then Isabel Net, and I show this ever so often. They post it from Real Investment Advice, and it ends up at Isabel Net on the blog there. It just the same headline. Earnings estimates are well ahead of economic realities, where they're projecting earnings to go up, but is that realistic? Is really what this chart is saying. And then this is a mishmash. Looks like a really scary spreadsheet here, but the part to really focus in on is the latter part of November here, where we tend to see positive returns going into the end of the month. I didn't want to include this in the seasonality because this chart is like, wow, I'm just overwhelmed with numbers. And I tend not to show charts that look like this, but since they had this area highlighted, I went ahead and did that. And then the valuations. We're seeing a lot of posts about valuations. I talk about it every week in the intermarket analysis video, and we've been overvalued for a long time, for years now. But at some point, the market may go, whoa, wait a minute, we are overvalued, and that would lead to a decline. And this is the median company PE multiple or PE ratio, where the 10 largest stocks were up over 30. That's expensive because we stick to that 10, 15, 20 scale, and we're a little bit below 20 when we look at the rest of the S&P 500. You take out the top 10 largest stocks. So not really overvalued at that point. But when you put the two together, we are overvalued because you can take out certain stocks, you can add certain stocks here or there, but the bottom line is when you look at the S&P in as a whole, it is overvalued on a historical and even on a forward-looking basis. Okay, U.S. equities currently price an optimistic growth environment. Okay, we're here we have the ISM manufacturing index. That's actually going down, and that's showing contraction. But there's another part of the U.S. economy, which are services that they don't have on here. But this is cyclicals versus defensives. When this is going up, the dark blue line, that tends to bode well that the economy's doing well. They cycle with the economy. That's why they're called cyclicals. Where the defensives, these are the things that hold up better and sometimes even advance when the market is going down. We saw that in 2022. And so when this is really going up like this, it just suggests that the economic outlook is still positive. Then Deutsche Bank, yes, got to listen to Deutsche Bank. Look at their projection. They think we're going to be up 17% a year from now from where we're at. They have the S&P going up to 7,000. We'll just have to see how that works out there. And then the indexed return here. These are the magnificent 7 stocks. And going back, they benchmark it to 100, going back to December of 2022, and just how well they've done since that time compared to the rest of the S&P. And then you take the rest of the stocks in the S&P and how they've done. I mean, even 35%, it's like, whoa, man, it really underperformed there. My goodness, since that low that we set, that's a pretty good return. A little over 2 years with a 35% return, that's respectable in and of itself. But of course, Folks like to focus on the ones that really outperform the market. And then best month this year, S&P 500 is set for the biggest monthly gain. Now Friday will be the last trading day. And unless we go down like 5 or 6% or something in Friday's session, we're probably going to end positive and end positive in a big way. It's going to end up being a really positive month for November. And then record inflows into US ETFs. These are all the rage now. And when I first started in the markets with the kind of program that I have and the kind of strategies that I implement, I used mutual funds, even though the SPY, which is now the biggest ETF, I use that now, but I wanted to give it some time to kind of play itself out and prove itself that it was really going to work. Well, now that's it. That's all the rage right now. And I deal with that in the basic course that I teach here. And we're seeing a lot of money going into ETFs. That's and not really a surprise with that. I didn't really spend any time on Twitter, just a lot of, I don't know, I figured I had enough to go through here. Here's the intraday chart where we had a lower open right about at the daily pivot, and then we broke down below the daily pivot. We got down below S1. We were able to find support here. It was below the 6,000 level, and then we came back up to S1, which now acted as resistance, and we closed a little bit below S1. And then things are pretty quiet in the initial overnight session. We're up just a little bit here. And we were up in the initial overnight session before Wednesday. Then we saw Europe is not doing all that good these days. And that really dragged things down as well. So we ended up going down lower. And then we almost came back to the unchanged level before the market opened. And then we saw the weakness throughout the day and the recovery going in later in the day. And then this is still a little bit of a concern to us on an intraday chart of 10 minutes here, where we see large cap value outperforming large cap growth. The red line, although it came down, is above the blue line. In stronger environments, we want to see the blue line above the red line. And here's a look at the S&P growth to value on an intraday basis, where we really started off quite weak, but then we were able to bounce back up here. And this is more positive. This is why we can still look a little more positive at the S&P 500. Yeah, we saw some initial weakness, but we saw some real comeback later in the day. So on an end of day basis, growth ended up being down where value was up. Where the mid caps, it was growth was down more, and it was up but up less with the small caps. So then I look at end of day charts where we saw a little bit of a tick up with small cap growth to value, but it's still in a longer term downtrend. If you can stay above both of these lines, eventually that would turn to an uptrend. Mid caps came down just a little bit, also still in a downtrend. And we're holding up okay with S&P growth to value on the end of day chart here. We would like this to go up. That would be more positive for the S&P, but the fact that it's not really falling apart is rather encouraging. And coming down just a little bit more into the middle part of the rainbow when we compare the growth to value ETFs. Discretionary did pull back here, but it's still looking strong overall and in an uptrend when compared to staples. Large cap growth was down, but still holding up for the time being. And we're not quite in a trend yet with the S&P when we look at the ADX or the average directional movement indicator. We want to cross above the moving average. That would be step number one, showing that we're getting stronger with the trend. And step number two, we want to go above this blue line, which is 20, which means we would be in a trending environment. The green line is on top, so we default to positive, but it is coming down with the down day that we saw in Wednesday's session. Short term, we're just trying to cross above the moving average, but we're also still below 20. The green line is still on top. And we did drop to below average with volume, not surprising there. As far as sentiment, we were pretty much flat with the VIX, both with the line chart and the bar chart. And we were flat here with the VIX of the VIX. So not an awful lot of pickup in volatility that way. And the momentum of the VIX is continuing to be down as measured by the MACD. And that's typically what we see with the VIX. Going through the month of November into December tends to be the positive time, with the VIX going down, with stocks going up. We're still getting a very high reading here with the skew index. This is a variation of the VIX and calculated in a different way. the market is still expecting some kind of a big move. And this could be some hedging or front running ahead of the holiday weekend, hoping to see something happen once we start trading again next week. And we saw this tick down a little bit with this fear gauge, and we were up just a little bit with this other fear gauge. So a little bit of contradiction there, and probably some hedging ahead of the 4-day holiday here for most people, where we saw an increase in put buying when relative to call buying. But we're still going down with the 5-day, and we're getting a little extreme here, just to give you a little bit longer term context. Sometimes when we get to a really low reading, but we don't know if we're done going lower with this yet, but when we do finally bottom out, that tends to mean a top in the stock market. And we're kind of just floundering a little bit lower here with the 10-day moving average as well. And the volatility risk premium still under the band and declining, not projecting any real risk 30 days out. Advanced decline line holding up fairly well, and it was actually up a little bit here, setting another new all-time high. We declined a little bit based on volume, but still it's coming off of setting an all-time high here. We did see an expansion of the new highs even with the down day. That just shows the rest of the S&P is participating. So we're going back up with the 5-day and the 10-day moving average. And coming down a little bit here, not we were a little concerned that we were getting far away from the moving average when we look at accumulation distribution. Well, with the slight pullback and this coming down a little bit, we're wearing that off a little here. But this is still positive since we're above the red line. And tick down a little bit, but still positive with the advanced decline ratio. Also, still improving here with the Chaikin money flow. We're seeing the histogram green and advancing, and we're seeing the red line moving average continue to go up. And we're kind of floundering around, but still positive here with the Chaikin oscillator. And a little concern here. We're still positive with the vortex since the green line's above the red line, but the green line's coming down as the red line's going up. And with the cumulative advanced decline line for the S&P showing another new all-time high, came down just a little bit based on volume. And where the S&P ended up being down, it's really hard to see, but we ticked up just a little bit with the NYSE advanced decline line here. And the cumulative advanced decline line on the NYSE setting another new all-time high, showing a little bit of an improvement here with the regular NYSE advanced decline line as well as this other NYSE advanced decline line. Not big, but it was positive. And based on common stock, we were up just a little bit based on price and volume, but not a real breakout move here. Still holding up okay with the advanced decline line. With the NYSE common stock, we were up slightly, up a little bit, even though the S&P was down, the rest of the stocks did okay. So that's helping the S&P 500 advanced decline line. We declined with the mid caps, and we were pretty much flat with the small caps. And small caps were down, but they were down less. So that then we say they outperformed because they were down less than the S&P 500. Ticking back up and looking positive here with those stocks in the S&P above their 20-day moving average. And here's our study. We're above 70, which suggests good, solid short-term momentum to the upside. A little bit of a tick up with the 50 period moving average, and a little bit with the 100, and a little bit with the 200. So this internal measure inside the S&P is still holding up for the time being. And we're not really setting an all-time high here. We set an all-time intraday high and an all-time high in Tuesday's session, but we're pretty much pulling back off of that right now. And you can see on the bottom where we're well below average with volume. So we're coming down a bit with the 20, 50, and we're still going up with the 200-day moving average for the S&P. Coming down, but still extreme with the Williams percent R. The Stochk RSI, after just barely getting extreme, has now dropped back down. The CCI 14, barely extreme, also pulled back. The CCI 20, which was never extreme, is also pulling back slightly. We are extreme, even though we're coming down in the short term with the short-term stochastic. We're extreme, but rolling over in the intermediate short term. We're also extreme, but still positive with the longer short-term stochastic. And that's a further subdivision of the short-term time frame. We declined, but we're still positive with the force index. The condition of the short-term trend based on 20 periods, even with the decline, we're still above the green line and the blue line. still above the simple and exponential moving averages, still in the +2 channel with our standard deviations chart. And not sure whether to treat this as a concern or not. The balance of power is really coming down. We're still positive since we're above zero, but the context is that this is seeing some weakness. And the condition of the intermediate term trend is measured by 50 periods. Excuse me here. We're still above the red line and the blue line. So that's still holding up for right now. We're still positive with the go, no go system with the darker blue bars coming off of the highest high reading here and well above the midpoint. That's positive. Still going up with the lighter shade of blue with the TTM squeeze. That's positive. This is also another little concern. The ease of movement going back 14 periods. We are declining, but we're still positive. And the Arun is flat after it had ticked up just a little bit here. And this measures the difference between buyers in green and sellers in red. And the difference between the two is the oscillator, and we're above zero. So this is still positive. Coming down just a little bit, but still positive with the S&P McClellan oscillator. So we're still going up with the summation index based on price and volume. Ticking back up a little bit with the NYSE McClellan oscillator and also above zero. So we're continuing to go up with the summation index for the NYSE based on price and volume. The Swenlin trading oscillator still going up based on price and volume here. That's positive. Momentum is shifting back and looking more positive when we look at the PMO, going up when we break it out based on price and lagging a little bit here based on volume, but it's still looking positive. Coming down with a little bit with the PMOs that are rising, but the buy signals are going up and we're still going up with the PMOs above zero. The slope oscillator is still hanging in there looking positive. The MACD is also switched back to positive. And we're looking more positive here in the short term, intermediate term, and the long term never did have enough time to switch over and look negative. So momentum is still positive, but we are turning negative with the copy curve. It's dropping below the moving average and going down. But this is different than all the other oscillators that we have. So we'll just keep an eye on this. Still going up with the Sean trend meter into this little darker green area. Coming down, but still positive with the money flow as well as the ultimate oscillator. Ticking down, but still positive above an advancing moving average with on balance volume. Ticking down, but still positive since we're above 50 with the RSI 14 and the RSI 9. Still above all the plotted moving averages. We've gone from positive to neutral with the Elder's Impulse system. We're still positive with the parabolic SAR. And this is generating a signal still, the Pring bottom fisher. It's picking out this decline and then sideways action as being some kind of a bottom that we are still coming up out of, and it's still generating a signal. And the bullish percent index is still showing an improvement here. We're not quite extreme yet, but this is encouraging. And this is different than oscillators and moving averages. This measures point and figure buy or sell signals in the S&P. And even though the S&P was down, it's still generating buy signals for this indicator to go back up. And we're going up with the NYSE bullish percent index, but we are declining with the NASDAQ 100 bullish percent index. Don't really have any support or resistance levels right now, other than what I'm showing in other charts. So we look at the trend using some chart variations here. The Heiken Ashi has open candles, and that's positive. The Kegi is black and pointing up. That's positive. The Renko chart has an open block. That's positive. And the three line break has an open candle bar type thing here. That's positive also. In the long term, still not getting up to this 400 level with the 150 or 200, but we're above the 350 level. That's still showing long-term positive momentum. Then we're still positive across the board according to the Keller market model with the different indexes and time frames. And we're negative in the intermediate term with bonds based on price, but positive in the short and long term. Commodities are still getting whacked in the short, intermediate, and long term. And some of this may be because of tariff fears and things like that. It's really pushing prices down in that area. But the dollar is still looking fairly strong across all time frames. And so we had real estate, which benefited a little bit. It's been getting hit pretty hard lately. Healthcare, that's another defensive area, as are staples. So we saw in Wednesday's session, the more defensive areas actually doing better. Financials continued to do well. Utilities were virtually unchanged, but we saw tech, discretionary. These are growth areas. Here, we want them to do well, but they didn't do very good. And then saw a little bit of a Christmas look here where the Dow setting an all-time high right at the open. Then the Nasdaq, it went below 19.1, then it got back above 19.1. Then we have the euro going up a little bit against the dollar. Real estate had a 2-year high when you just look at the ETF. And then we had the euro bearish 50-20 crossover. So it started off good, but then it's not looking too good on a trending basis. And then let's see, the Nasdaq kind of bouncing around. We did have the S&P setting an all-time high, but that was a little bit later on there. That's kind of strange. And then we got back above 6,000 with the Dow setting a new all-time high. Energy has had a bearish MACD crossover. So not much of a change here with the equal weight versus the weighted version of the S&P. We're still positive with the diamonds. Okay, this is out of order here. Here's the Dow, which did come down 1/3%. The Nasdaq, we're still wondering, can we get above this dashed pivot point resistance, which seems to matter to the Nasdaq. So if we can get back and close above this dashed line, that would really help things a lot. But this is going to switch over into a new month once we start in December, but it still could be a viable level of resistance. Also seeing that same overhead resistance with the NASDAQ 100. We've gone from positive to neutral with the QQQs. The momentum for the NASDAQ 100, though, is still negative as measured by the PPO. And we were, as I said earlier, we were down with the small caps, but down less than some of the other indexes. So we say they outperformed. And when we look at the Russell 2000 small caps, pretty much flat with the RSI. This index was actually up a little bit. So we had the S&P small cap index down where the Russell 2000 small cap index was up slightly. And the momentum is positive for the Russell 2000 small caps. They continue to be positive when we look at the Elders Impulse system. The mid caps were down 1/3% here, and we've gone from positive to neutral with the Elders Impulse system. The Wilshire pulling back 0.35% after setting an all-time high. Also pulling back 0.34% with the total US stock ETF after setting an all-time high here. Financial sector still going up, still setting all-time highs. And we're watching that to see if there's any kind of a financial meltdown type of a thing. It's not being reflected by what we see here. Things are looking pretty good in this area. The FANG index declined. This is one of the areas that got hit a little harder. This is Facebook, Apple, Amazon, Netflix, Google, Nvidia, and all the big favorite stocks here, but it's still looking positive. We're still below the shorter term trend line. We're still above the longer term trend line here with the FANG index. Apple was down 0.06%. Amazon was down over 1%, but still looking pretty good. Microsoft, we're wondering, is a death cross going to be generated here? It hasn't been generated yet. It's 0.23 points away from that happening, but it hasn't happened yet. Google was up barely, virtually unchanged. Meta was down 0.75%, dropping a little below its 50-day moving average. Nvidia down 1.15%, also hanging out around its 50-day moving average. Tesla down 1.58%, still looking pretty solid though. Netflix was up another 0.5%, more than that, still coming off of a recent all-time high. This is another area that's a concern, and we're watching Microsoft and we're watching the semiconductors right now. We've already generated a death cross here. You can barely see it, but the blue line's below the red line. If this really continues to show weakness, that could be quite negative for the market. Doesn't seem to have as much of an impact yet. It really led things to the upside when we saw the golden cross. Is it going to lead to the downside if we continue to see more weakness in this area? And then this is another thing, semiconductors to the Dow. We've been falling a little bit here with this ratio. A little bit of a concern. We just want to keep an eye on this for the time being. And we're still seeing an improvement in the short term when we compare US to world stocks. Longer term, we're still seeing that correlation deteriorate. Oil is dropping down a little bit more here because I'm attributing that more to the ceasefire going on right now. This has been acting more geopolitical as far as the price of oil. And we're just getting ready to see a golden cross here with the dollar. So we'll have to see. We saw a death cross and then it started going up. If we see a golden cross, is it going to start to go down? That's the problem with moving averages, is that they lag and you can sometimes lose a large part of the move by using them. And we were down with the 10-year yield. We were up with the 10-year based on price. And then looking at our growth to value ratios, not really seeing a strength here with the Qs to S&P. Discretionary to S&P still looking solid here and above an advancing moving average. Still below the moving average when we look at large cap growth versus large cap value. So the large caps under the moving average, coming down but above the moving average with the mid caps and the small caps. So what's our outlook for Friday? We are still positive, and we are in a series of days and a season where we have positive seasonality. There will be an abbreviated session on Friday where I'm not living there now, but when I'm on the West Coast, you finish at 10 a.m. I mean, that's really cool. I like being able to finish work at 10 o'clock in the morning, but that's not where I'm at now, so the time is much different. We will get I thought we had the Chicago PMI on Wednesday. Well, according to the calendar, maybe we'll get it again for people that weren't listening. And then the geopolitical things, including the election and anything going on there, anything crazy that could happen in the U.S. We are over a holiday weekend. There's a supposed ceasefire between Iran, Hezbollah, Hamas, and Israel. Things could always escalate between Russia, Ukraine. There's a lot of potential things, but the market is pretty much ignoring those things for the time being. And then we're supposed to get Chicago PMI on Friday here. See, it's even on the calendar. All right. Then seasonality, we're neutral to positive with the Dow, where we're neutral to negative with the S&P and Nasdaq. So not a real edge either way or the other for Friday's session. And we do tend to be positive here between the Tuesday before Thanksgiving going out to the second day of the new year, both with the S&P and with the small caps. And we'll be on the last trading day of November here, where we're pretty much flat when you look at the green dashed line, which is the S&P during an election year. But so far for 2024, we're just leaving all of the other averages and comparisons in the dust. And we do see positive seasonality going into the end of November, Thursday. Actually, I'm sorry. This should be Friday. I should have moved that over one more space. I'm so used to just doing it one space here. Friday is the most positive day of the week so far in 2024, and we're coming up into the end of November where we also see positive results according to Tom Bowley's research. And then this is looking ahead into December where we're up 83 and a third% of the time with a return of 1.3%. Also positive seasonality according to the Carson chart. Here's the post-election results and also the results that happened after 2020. So we are a little concerned here about the Copic curve, but it's not showing us the same thing that we're seeing with our other oscillators. So there's not a confirmation there, but we still want to know that that's happening. And the momentum for the NASDAQ 100 continues to be negative. We also have a non-confirmed Hindenburg omen. We're waiting to see if another spike up will come there. And then the positive side, we're still looking pretty good here with our smart money indicators when you take all three of them together. And we're still positive with the McClellan oscillators and summation indexes, both for the S&P and NYSE, the Swenlin trading oscillator. And the reason this is yellow is when it's gold like this, I consider that a primary indicator. Yellow is kind of right in between a primary and secondary indicator. And the vortex, which is a primary indicator, is positive. We're still pretty much going down with the 5-day and 10-day equity put call ratio charts. Growth to value for the S&P is still holding up, but not really breaking out, underperforming on an intraday basis. Discretionary to staples pulled back, but it still has been outperforming in the bigger picture. And our oscillators are really improving and starting to turn more positive again. The advanced decline line, especially for the S&P, setting another new all-time high. Can't be more positive than that. And our moving average studies are still positive across the board. The parabolic SAR, the bullish percent indexes, the ease of movement, and the money flow. When they're in white like this, they're secondary indicators that I use. And the ultimate oscillator is still positive. The financial sector is also positive. And then here's the Hindenburg omen. If you want to pause this and look at the three criteria that make that up. We do not have a second spike up yet to confirm that, and we have until December 19th for that to happen. So our conclusion, haven't really changed things here because not much really has changed. We are positive when you take everything together. We're still not trending in the short or intermediate term, but we are still seeing signs of an improvement, and we're in positive seasonality. We're positive in the short term, and we're also still positive in the intermediate term. And we continue to be positive in the long term. Thank you. Again, happy Thanksgiving to all of you. Have a great day, and I will talk to you in the next video.